Right then, afternoon folks, and just another update from us on the goings on across markets this week. We'll start with the calendar. We'll have a quick flick across the charts and see what we can find. Monday and Tuesday, as you can see, pretty light on the economic calendar. Not a great deal to go off. We did come into the start of this week off the back of some pretty strong moves into the close on Friday across major stock indexes. Continued on into Monday with no real fundamental driver. Not really much to kind of pinpoint any sort of direction from. It's pretty aggressive move higher. Maybe that's the reason. Maybe just there's no fresh reason to send it lower, so that's maybe why it went higher. But some pretty aggressive moves higher. That sentiment has kind of remained in markets over the course of this week. It's not really flown higher off the rest of the week, but we have managed to establish a foothold higher, even in the midst of some positive data out of the US yesterday. But we'll flick across the calendar. As you can see, inflation, CPI print out of Australia on Wednesday. We did have on Tuesday evening, 9:30 London time Tuesday evening, Kiwi inflation as well. Came in slightly hot in New Zealand, but Australian inflation, as you can see, 0.3% above consensus. I only have the high impact data on this calendar, but the medium impact, the month over month figure, it was the same. Or the quarterly figure, was the same, as 0.3% increase over the course of Q4. So still means that the Australian Central Bank, the RBA, Reserve Bank of Australia, still have a bit to go in terms of keeping inflation down, or bringing inflation down. So keeping it down, they haven't managed to get it down just yet. Still need to do a bit, still need to hike rates further in order to cool down inflation, certainly in Australia. So there's a bit of positivity certainly around the Australian dollar, as coming into that, which did pull back over the course of Wednesday. What we saw over the course of Wednesday was some fresh updates on Germany and the US sending tanks to Ukraine in order to help with their ongoing war against Russia. Some other countries are happy to send arms and stuff. There was an agreement between a number of countries that they will give more support to Ukraine, which was ongoing in markets for a couple of weeks. Markets did see a bit of downside. There was a bit of negativity, and risk sentiment took a hit on Wednesday morning off the back of that, which has since been reversed. But in terms of what Russia can really do back to that, I don't really know. They'll know themselves that nuclear warfare will not end well for them. There's not much they can really do other than what they are doing. So markets where you read some analysts and stuff, saying across the different finance related news sources that we're waiting on some retaliation from the Kremlin, but in my own personal opinion, there's not really they can do. They're not gonna blow up Ukraine in terms of nuclear warfare. That will not result well for them. That will not end well for them. So they will know. They won't be stupid enough to do that. I personally don't think, but obviously I don't know what goes on inside their heads. So we'll have to see. But pretty much a non-event for me. Bit of downside off the back of that, quickly been reversed. So yeah, for me, bit of a non-event. We come into the Bank of Canada interest rate hike of 0.25%, as you can see on the calendar. Last hike of the hiking cycle. They will be reluctant to hike further, given the nature of household debt in that country, the high levels of household debt in that country, the relatively overvalued house prices in that country. Obviously, the rising of interest rates, the further interest rates rise, the more of a problem it's going to cause for households. So that is the last hike in their cycle. They did give a pretty explicit viewpoint on that it was going to be their last hike in the cycle if the economy continues to follow the path of their projections. But they are open to hiking rates again if needed, if inflation does not get under control, if inflation continues to rise, which there is a bit of a risk for. I mean, global commodities are kind of rising over the course of this year so far. Copper's up double digits from the lows, oil's up double digits from the lows, and if those sorts of commodities continue to rise off the back of China's reopening, and China's reopening continues to gather pace, and those commodities continue to rise in value, what that does is it creates further inflationary pressures across the global economy and causes further inflationary pressures for each individual country, and obviously Canada are a large exporter of oil, so higher price of oil is positive for their economy, but it also does cause increased levels of inflation, which is going to cause increased interest rate hikes if that continues to persist. So not a complete we are never hiking interest rates again, but they said they don't want to. But if they have to, if that sort of situation continues to play out, if commodities continue to rise in value, it is something that they are prepared to do if necessary. Into the US then on Thursday and Friday, you can see durable goods orders and GDP out of the US on Thursday, numbers for December, and then the GDP figure the advanced figure for Q4 of last year, both positive, both above consensus. And normally, it's certainly in the past kind of 6 months or sort of around that time, positive numbers have meant that when the central bank can continue to hike interest rates at an aggressive pace. But now it's sort of a little bit of a different picture. I mean, with those positive figures, with those strong figures, durable goods orders being a manufacturing number, GDP obviously being a growth figure, it then kind of says to us that the economy is maybe not looking as bad as some people had initially feared, and with the central bank slowing the pace of rate hikes and slowing down the pace of rate hikes and approaching the end of their hiking cycle, the more resilient the economy can remain, the less chance of a deep recession, and the markets can kind of take that as a bit of a positive. We then come into inflation today, some inflation figures today. Personal spending, consumer spending down a little bit. Personal income in line with consensus. Core PCE, the Fed's preferred metric of inflation. Personal consumption expenditure, and the core measure for that, bang in line with consensus, although it has risen over the course of December. 0.3% increase. So inflation still rising, but not more than they anticipated. That is what markets have anticipated. And it's a bit of positivity certainly at the US Open today. We'll flick across back to the charts and we'll have a look. But we have a look across to this, you can see a couple of interesting points. I mean, we'll just flick across the dollar. Dollar's relatively flat, not much to see here in the dollar, but I think one thing of interest is the US 10-year yield, bond yields are higher, and also the S&P is higher. Now, that's not been something that has correlated quite clearly in the past number of months. Lower yields is then positive for risk, higher yields is then negative for risk, and the fact that we've seen upside across both of those assets today, I think is pretty interesting and important to look at going forward. If that relationship breaks down, we may not be able to look towards those yields for direction going forward, as this S&P 500 is making a pretty strong attempt at breaking through this trend line, breaking through 4,000. You'd imagine, unless we get a 70-point drop over the course of the rest of the American session and into the close today, and we are going to close above that. It's quite a big technical break, quite a clean technical break. If we can get up through that, we failed a number of times last week and obviously last month as well. As you can see, we never really managed to sustain any sort of price above that. We've been up for a few days this week. Every single close this week has been above that 4,000 round number. So keep your eyes on that. That continues to rally into the close. That is positive into next week. But risks do remain in markets. The central bank are technically still hiking interest rates, although approaching the end they are still hiking them. You've got difficulties for the economy going forward, right? And then you've got a potential recession going forward. So there's a couple of different things we need to keep a lid on. Definitely need to keep a lid on expectations, but I think cautiously long probably seems the way to play it as of now. Oil. You can see WTI up at this resistance level, struggling up around 82, round number of 82. Hasn't quite managed to break it this week. We've had a couple of attempts of it, sitting in and around that resistance level, as we can see there, this kind of zone with the box. Interesting to see if we can break above it. If we can break above it, get a daily close above that, get a weekly close above that, that would be nice. But it does look like it wants to try and push higher. But obviously we'll have to see how that plays out. But for now, I think cautiously long stocks seem the way to play it. Any sort of excuse to buy stocks over the last couple of years, last 3 years, people have taken advantage of it. So you don't want to miss those types of moves higher. If you can get long, try and get long, but you've got to keep a lid on your expectations. I say cautiously long, and obviously we'll have to see how that plays out into next week when we've got the Fed. Right, we've got the Fed, another 25 basis point hike is what we're expecting. Fed are expecting a terminal rate of 5.1%. Markets are pricing in 4.9%. Probably see 25, maybe another 25. But some market participants are suggesting that we will get the Fed going on pause after next week. My personal opinion, they probably go to 5% to 25, another 25, and then go on hold, and then we'll have to see. In terms of them cutting later on in this year, that's a different question. We'll cross that bridge when it comes to it, but I'm not so sure about that just yet. Inflation is only a minus 0.1% decrease over the inflation print of this month, so not really much to go off. Not much to go off there. We'll have to see then how that plays out going into the future. But with rising commodity prices, there is definitely risks to that. You've got rising commodity prices, technically still rising interest rates, and potential recession fears later on in this year. So definitely something to keep an eye on. But the Fed next week, 25 basis point hike. Do we get some guidance as to when they're going to end that hiking cycle? We'll have to see. The Bank of England as well. We got the Bank of England 0.5% hike, a spot 5%, 50 basis points, whatever terminology you want to use. 50 basis points out of the ECB as well. We have had some hawkish rhetoric out of the ECB over the last couple of weeks. ECB is not especially expecting that we're going to see a 50 basis point, then another 50 basis point, and then probably smaller hikes then going on after. So still a bit of work to do in terms of the European Central Bank. Christine Lagarde did say early on in the week that that inflation is still too high and it needs to come under control, but they're like a broken record at this point, these central bankers, aren't they? But apart from that, you've then got NFP, you've got non-farm payrolls to wrap up a busy end to the week, a busy start to the week as well. You got a raft of GDP figures out of Germany on Monday, out of the rest of the Eurozone, of Italy, France, Eurozone as a whole. You got German inflation next week expected to continue to rise. So with rising inflation still in Germany, with the ECB still needing to hike interest rates, obviously 9.2% in Germany is far too high. And they still got a fair bit of work to do, as they have already admitted to. But into NFP then, into the unemployment rate and non-manufacturing PMI on Friday to finish off a busy week on the economic calendar. We are expecting less jobs added to the economy as opposed to last month's figure. We're expecting the unemployment rate to rise slightly, but we're expecting a non-manufacturing PMI above 50. So we'll have to see then how that plays out. But unemployment is at very low levels. The Fed expect that to raise to 4.5%. That is in their projections. So you would imagine at some point we will get unemployment to start to rise. But does that make much of an impact on markets? We'll have to see at the end of a busy week next week. But that's it from me then, folks. I'll let you get on with your afternoons. Have a nice weekend. Do recharge the batteries, get some rest and relaxation in, and we'll speak to you again next week after another week of trading. Thank you.